When you hear the news say the market reacted poorly today or the market is optimistic, what do you actually see in your head?
Most people imagine a single giant entity, like a weather system or a hive mind. But here's the truth: the market, as you know it, doesn't actually exist. It's not a single thing. It's a collection of five very different groups of people, all fighting for the same dollar but using completely different rules. If you don't know which group you belong to or who you're up against, you aren't investing. You're just providing the profit for someone else. To navigate today's landscape, you need to understand these five players. We call them smart money, slow money, quick money, gamblers, and, for lack of a better word, stupid money.
Let's start at the top. Smart money. These are the hedge funds and big banks. They employ armies of analysts to find that tiny 1% edge. They have the data, the resources, and sometimes the inside track before the public even wakes up. If you're an average investor, your goal isn't to beat them. You can't. Your goal is to make sure you aren't the liquidity they're profiting from. Even though they make supernormal returns, they are actually a small fraction of the total cash in the system. They don't control everything. Next up is slow money. These are the anchors of the market. Think massive pension funds, insurance companies, and long-term index investors. These players are often bound by strict rules. They have to keep their money in certain categories regardless of what the news says. This group is the reason market crashes take weeks or months to play out rather than happening in a single afternoon. They provide the stability. The downside? They ride the stairs up during the good times, but they also ride the elevator all the way down during a crash. But for the invest and forget crowd, it usually pays off in the long run. Then we have quick money. These investors join the party a little late. They see a trend, wait for confirmation, and jump in. Their biggest enemy? FOMO, the fear of missing out. If they get too excited, they buy at the top. But if they're disciplined, they're often the ones who get out soon after the downturn starts, keeping their losses manageable.
Then come the gamblers. These folks don't care about value or logic. They want the 10x gain overnight. They buy and sell constantly, creating a lot of noise that makes prices bounce around for no fundamental reason.
Finally, there's stupid money. Look, we've all been there. We've all trusted a dodgy tip or let our emotions take the wheel. Stupid money represents those moments where people act in large volumes for reasons that make zero sense. It happens in every segment. Even the pros get stupid sometimes. And it's what creates those wild daily price swings.
How do we know this is real? Just look at how the market reacts to a crisis. When things spiral downward, you can actually see these groups separate. The smart money has already left. The quick money is panic selling. The slow money is holding steady. And the gamblers are doubling down on the dip.
You can see it in the products being sold to you and the way the news is written. It's all segmented. But as always, let's bring in our peer reviewer, Pete, to see if he can poke some holes in this. Pete?
Thanks. Look, John, it's a neat way to categorize people, but I have to play devil's advocate. First, where are the hard stats? You're basing this on observed behavior and narratives, but you haven't shown us exactly what percentage of the daily volume belongs to gamblers versus slow money. Without hard data, it's just a theory. Second, so what? Knowing these groups is one thing, but can you actually use this to predict the next move? If it doesn't help me time the market, isn't it just guesswork?
Fair points, Pete. And you're right. This is the foundational vibe of the market. To get to the predictive stuff, you have to look at how these groups interact, which is exactly what we do in our upcoming videos. We've covered the who of the market today, but this is only one of 30 critical topics every serious investor needs to master. I highly recommend our comprehensive guide on Amazon. It pulls the best insights from this entire 30-video series into one high-level manual, including exclusive deep dives we can't fit on YouTube. Check the link in the description to grab your copy, and I'll see you in the next videos when we talk about market crashes and bonds.